Don't forget that. Welcome to Silvercrest Opportunity Fund.
All right, do a little countdown here.
Passive, really I think this massive, stable cash flow, lavish, about to finance for the masses, this 14% in manufactured housing. Really all the deals I've been doing is kinda hard to keep them counting. Not really, 10% for the year, it's clear that this the new wave. Little competition in my arena, need a house, man, you call Serena. Strategy so boring, didn't even mean to not remind them. There's another check right behind them, 10% passive. The checks outlined with collateral, 150 performing notes. I think I should take a sabbatical. Adaptable with the terms, justify that 1 year that you earned.
10% here today on another edition of the Mobile Mailbox Money Mastermind. A lot going on in the industry, a lot of people kind of coming out of the woodwork, a lot of new investors, new inquiry, new questions, new content. So I appreciate each and every one of you being here today. We've got about like $500,000 in notes potentially available. Quick preface, go back and view the previous podcasts, vlogs, and other masterminds. Unadulterated value, lots of gems to be learned, as well as free education. What more could you ask for at the end of the day? Got a lot of podcasts and stuff dropping. We just had Fred and Tracy of the noteinvestor.com, had Paulie D, land investor that's operating in the path of progress here in Arizona, and a plethora of other individuals that we've interviewed recently, like Nate Hare from Directed IRA, teaching people how to invest in alternative assets like real estate notes, manufactured housing, using your IRA, solo 401k, TSP, and a whole bunch of other different accounts that I'm actually becoming aware of. So that was kind of cool the other day with Nate Hare at the Arizona Real Estate Investors Association. We've got, I think, a discount code if you have money in an IRA looking to have a custodian hold your assets, tax deferred or tax free. So that's just a little preface. Today is brought to you by Silvercrest Opportunity Fund. We're currently raising accredited for a 1-year term in bank quality notes at 10% net paid monthly, or 3-year term at 12% net paid quarterly. That's a 506c Silvercrest Opportunity Fund. That's a little house cleaning. Appreciate each and every one of you being here today. The main topic of our discussion is raising private capital for real estate notes and how that works, how we hypothecate, how we pitch investors at the end of the day. And I've got another seasoned professional hedge fund manager, Patrick Franz, on the call today as well. Seasoned professionals raising millions of dollars for notes. Patrick, what are some of kind of 2 tactics that you've used recently to raise for notes? You kind of hit me up recently about people that were interested in notes. What was the caveat that you had pitched to them?
Yeah, I mean, I think that a lot of the investors recently got reminded of the volatility of the stock market. I think a lot of investors are starting to creep into the cryptocurrency markets, but understand that that's also an extraordinarily volatile space to play in. And you can kind of go on down the line, right? It's hard to cash flow in physical real estate right now because the prices are extraordinarily high and the interest rates are ridiculous. And so it's tough to cash flow. Along the lines of a bubble, people thinking too that there's going to be a real estate crash, which is cyclical about every 15 to 20 years or what have you. And we're kind of due. So, all that stuff, it creates uncertainty in a certain category of investor that maybe is a little bit older. I like to categorize people at 40 to 70 years old that are risk averse, that are looking for cash flow and security. Right. And so that's how I go about presenting the opportunity to people, just the way I said it here. To be honest, it's talking to people authentically and saying, hey, you know what? Geez, the stock market's pretty volatile and crypto, people don't even know about it and they're all scared to get into it, and how to custody their own crypto and get a crypto wallet and all this stuff is foreign to them, especially the older age folks. the IRAs they have that they've worked their whole lives to build up are attached to the stock market, managed by some other knucklehead. So, I mean, I like talking just this way freely with people and saying, hey, what if there was a better option for you? Right? What if there was a better option for you? More security, but more security, more upside, steady, predictable, contractual cash flow without fluctuation of markets. And it works for Republicans and Democrats alike. But I like just speaking in those logical, simple manners to people without using big language or acting super smart or any of that, because it's really not, guys. It's investing in debt. It's investing in debt that's secured by some sort of hard real estate. And if you're looking at the numbers and you're looking at how you invest in these assets, it's very, very difficult to go backwards. And as Will Rogers mentioned once, right? It's a famous quote that says, I'm more concerned with the return of my money than the return on my money. So this is a great place for those people that understand this mindset and philosophy the way I'm speaking it. And then they become a very good potential funding partner for your business then, if they are attracted to this stuff. So you guys realize why I'm not going for the 25-year-old cryptocurrency investor and presenting this opportunity to them? You get it, right? Yeah.
So those of you that don't know, Patrick runs the Note Investor University and Everly May Fund. So today's for a little bit more of the seasoned note investor, because raising for notes, hypothecating notes. So, obviously encouraged to gain education and figure out those due diligence items. If you're more new to the industry, go take some education modules and get your due diligence check boxes with the Note Investor University. But hypothecating for notes, pitching private investors with the deal flow opportunities in front of you, right, for collateralized lending opportunities. And really for investors, the main things that they're wanting to know, right, is it, do you have collateral, right? Is there, is there a tangible asset for that to be secured to? What's my return, and how does that stock stack up to comparable real estate investment strategies? So when an investor goes out in the market and they're looking at the breadth of opportunities, they're most likely going to try and entertain a long-term rental strategy on a single family property, right? They're going to entertain that first, most likely, and see what that looks like. How does that pencil out, and if it works for them? So in Arizona, average purchase prices are $465,000. We'll call it 450, right? That's $450,000 that someone would either have to come out of pocket 20% with a DSCR loan, or cash out refi, or pull money from a stock investment, and ultimately purchase a single family property to cash flow out in the market. So typical down payments are like 20%. So 450,000, that's 90,000 bucks they had to come out of pocket, right? For 90,000, that's their down payment. 90K. Average rent here in the Valley is about 2,000 bucks a month for an average single family property, right? So you're at 90,000 out of pocket. There's probably another 10, 20K in incidentals, right, of electrical or plumbing and things of that nature that need to get established to make it a turnkey rental, right? So say you're into it for 100. We'll say 10,000 for incidentals. That's pretty conservative. You got 100,000 into the property. It's renting for 2,000 a month, right? Just call it 2,000. Could be a little bit more. Call it 2,250. $2,250 a month for a 3-bedroom, average $450,000 home, and you have about $100,000 into the property. Well, your DSCR loan, James, what are DSCR interest rates right now? Is that 9%? Is that 6%? Is that 12%? You're muted right now, James. Oh,
As you can see, I'm not a DSCR specialist, but I can.
So we have 4 single-family properties in South Scottsdale that we rent out. What are we paying? I think it's like 9%.
So
Only
it's about 8% on a DSCR loan.
So say it's 8% interest only, which is what normal DSCR loans are. So 8% interest only on a $450,000 home. So grab your little calculator here. 450,000 times 0.08 divided by 12 is $3,000 a month. Your payment is actually more than what you rented for. Right? So your average rent's $2,250. Say you furnished it, right? And you're getting $2,500 to $2,700 a month, or it's in South Scottsdale. You know, obviously that's going to affect your price point and things of that nature of your acquisition and all-in cost. But you paid you had $100,000 out of pocket to cash flow negative over $500 a month. So you're losing $500 a month on a long-term rental strategy with $100,000 in the Arizona market. Really, you're banking on appreciation, right? So average appreciation nationally is, I think, 5%,
Right.
5 to 8 or something of that nature. Pretty sure it's 5%. So 5% of 450,000 times 0.05 is 2250, 22.5. $22,500 divided by 12 for a monthly is $1,875. Monthly. Forgive me if you can't see this right now, but so that's a monthly appreciation average, $1,875. You know, you're cash flowing on an appreciative average of, say, like $1,200. So you're making $10K a year. That's not including your insurance, maintenance, property taxes, management fees. You know, if Jenny May clogs the toilet too many times, you know, you got to call the plumber. So you're really losing money here. And considering average appreciation nationally has plateaued, there creates an issue right here. So if you're looking at a long-term rental strategy, and I know your issue, it's called negative cash flow and plateaued appreciation. Well, what if I told you with this same $100,000, literally the same money in the same market, in an adjacent strategy with first-lien position performing collateral? Let's run it back real quick. So we buy $100,000, say, note, and I think I have one right now at 110, but we'll talk about that here in a minute. Same $100,000, literally same money. You alter your strategy and become the bank. Well, what does that mean, right? You insert yourself in the position of a private lender and collateral-based lending in a performing nature. So a note is a first lien position mortgage. Did you know you could buy a mortgage? So opposed to paying the bank 8% interest over here, you insert your position into almost the DSCR lender's position, right? So even though this guy who bought this single family property is negatively cash flowing, you know who still made money? The bank. The bank still made 8% interest. And on top of that, this position pays even more than that. So we'll leave that for here in a moment. So same 100 grand, right? For a $100,000 note in a first lien position, let's just look what our averages are here in mobile mailbox money and what someone could participate in. Just average benchmarks. Average acquisitions are like 80 to 120,000. Okay. You've got $100,000 acquisition or lien position, unpaid balance in a note or mortgage on a 20-year term, which we'll talk about how you won't have to hold it the whole 20, right? For 20 years, $100,000 is cash flowing $1,243.52. Your position is backed with collateral, first lien, only lien on the property, performing with no banks, Zero banks, you're the bank, you became the bank, stepping into a private lending component with an underwritten borrower, cash flowing $1,200 a month, when the alternative in a long-term rental strategy is negative cash flow. So when pitching this to private investors, here's the proof in the numbers and proof in the pudding. If they can just conceptualize becoming the bank, right, and no longer having to get a loan for a property, they become a private lender and start cash flowing $1,200 a month with no banks in a 30-day program. I think that starts to open the eyes of a lot of individuals, who maybe don't see or understand the program. This is almost life-changing, understanding how to subvert the banking cartel at the end of the day and step into positions like the Rothschilds, JP Morgan, and things of that nature. So with that same money, you're now life-changing financial freedom, away from stacking 5 positions like this and making $5,000 a month with $500,000. No matter where you pencil this in on a long-term rental strategy right now, it doesn't make sense unless you're acquiring through creative acquisition, subject to, if you're buying on a 3 to 5% mortgage, and that's kind of shaky right now, with a lot of flack being had from that strategy. So that's kind of where the rubber meets the road. Patrick mentioned that people are really kind of starting to get tired of the fluctuations and the hair loss in the stock market. It does end up coming back around, but you got to wait for that point, for that bottom out, to now bounce back up to a palatable position. Point to point, what if you had to sell that day at the end of the day? That really does a lot psychologically to high net worth investors that have stuff fluctuating $500,000 or $1 million in one day when they could be sleeping at night with a collateralized position, right, in a safe, stable, performing nature with a double-digit yield. Whoa, forgot to mention that. And if you don't have a mortgage calculator, you're doing yourself a disservice. I did encourage you to get some further education with the Note Investor University, because that's probably one of the first things that they'll do is have you download a mortgage calculator. But double-digit yield. So they call that sleep at night money. Nathan Turner actually told me that, and I've never hit so true in my life. Stable, performing, contractually agreed upon returns with a double-digit yield. And I think a lot of people fail to see because there's not a lot of deal flow of notes like this. Most people have to go and, make propositions at discounts to hit higher yields, have to scour the internet or paper stack or go to conferences in order to find notes of this caliber. You can find 5 notes like this a month on mobilemailboxmoney.com. So what does all of this boil down to? It boils down to the pitch to an investor parlaying your knowledge in performing collateral and using OPM, other people's money, to ultimately cash out, refi your position, $100,000, or even not even come out of pocket at all your own money, and parlay your relationship, ultimately making a margin on the interest rate. That's called hypothecation. Go ahead.
Alden, this is where we insert our favorite saying: no tenants, no toilets, no termites.
Absolutely. In adjacence to a landlord and tenant strategy, with all the benefits of earning in real estate without owning in real estate. At the end of the day, the landlord ticket has an emotional satisfaction, I think, for a lot of people. I own 10 properties. I own 20 properties. Listen, that is not as easy as it sounds, especially when you're trying to go out and find additional opportunities. they're few and far between. And I think the education behind notes and lack of education publicly, available, not to the layman, most people don't even know that there's positions like this. So it's up to us to parlay our education and the deal flow that we have monthly, say 5 notes a month, to go out and hypothecate these notes, raising private money for these positions. Well, how do I do that? How do I use other people's money to navigate a position like this and use none of my own or some, or, I acquire it first, or I have a portfolio of notes that I've bought from Mobile Mailbox Money? All opportunities to hypothecate a note. Hypothecation means to pledge an asset in order to garnish capital investment. I was talking to one of my investors the other day. We were down at Hillstone in Phoenix, and he didn't understand that he can borrow against his positions and parlay his relationships, borrowing at a lower rate than what the note is performing at, and go out and buy more notes. The thing we come to realize is, as you infatuate yourself with note investment positions, you end up running out of money. We only make so much personal finances at the end of the day. If there's enough notes available for you to actually run out of money in your acquisitions. So when you acquire these notes, the BRRRR strategy, I think, got a lot of attention for a long time: buy, rehab, resell, refinance, repeat, or rent. Sorry, not resell. But in this case, it's the same thing, right? We buy a note, it's performing with trackable performance, and we go parlay our relationship, another bank or another person that's going to position themselves in the bank. You give them your collateral of the note, the $100,000 position in first lien performing. So you're providing that in that relationship, your aunt, your uncle, your mentor, your all the above. This $100,000 position, you're giving them a pledge, right? You're pledging this asset, this position, physical collateral, in order to garnish capital investment, right? So you're not pooling funds. You're actually taking a collateralized loan out on a position, almost like a bank, how you would seek a DSCR loan from a bank, right? So you pledge that to, say, Uncle Joe. Uncle Joe wants a 10% return, and this note pays 14, say hypothetically, right? You buy a 14% note, you pledge to Uncle Joe for a 5-year term at 8%. You not only pulled every dollar out of this position, you don't have to do 100%, depending on what the position entails. But hypothetically, you could pull all $100,000 out and still be making a margin on the rate from 8 to 14. You're making 6%, and you literally pulled every single dollar out of this transaction. 6% on $100,000, that's $6,000 a year. And not only that, you used that same 100 and you went and did it all over again, right? So this is where the true financial freedom starts to take place, because not all of us are high net worth and have $5 million, right, to gain enough ammunition in order to facilitate a passive return. You could start with $30,000. You could start with $50,000. You could start with $75,000 in a position like this and start to stack your positions, parlaying your relationships and the conferences and associations that you go to. Ultimately, and depending on how early you start, that could be really substantial. And I talked to seasoned note investors that have done notes, 500 notes, 1,000 notes, 100 notes. They didn't do that all with their own money at the end of the day. Patrick, how many notes have you guys, seen throughout y'all's venture as investors? Probably substantial.
Yeah. Yeah, to say the least. No, I mean, it's you're on the right track with saying that people run out of their own liquidity very quickly. And of course, whatever endeavor that you're involved in, whether it's house flipping, mobile home flipping, landlording, buying notes, buying apartments, all this other stuff. The fact of the matter is raising private capital from others that don't have your drive and skill set, but want to ride on the back of your intelligence level, your drive and your skill set. They want to win financially from your efforts. It's a match made in heaven. I always say that raising private capital, and like you said, making an arbitrage, right? If I can pay my investor 8% because that's doubling what they were getting in their IRA anyways, so they're happy with me getting them double the return they were getting in their IRA. I pay them 8%. I have a note from you guys that pays me 14%. It's a match made in heaven, isn't it? It's similar to a magic ATM machine that you would go ahead and put $20 into the ATM machine and it would spit you out 25. And then you'd put $20 into it, and it spits you out 25. And then you put another 20 into it, spits you out 25. I always just ask people, how long would you stand in front of the ATM machine shoving 20s into it?
So I don't think anybody would go to sleep, hit the tape.
Yeah, you would just keep doing it until it ran out of money to give you back, right? But it's like you put 20 in, and I attribute that the $20 we put into the ATM machine in this business that's the effort that we take to gain our expertise in a niche asset class that makes you very valuable to people that do have money. So it's hard work. It's training, it's questions, it's mastering things like the financial calculator, like Alden was saying. It's mastering the due diligence process, the acquisition process, asset management, foreclosures, exit strategies, these kinds of things. You put in on all that effort, and that's you bringing your $20 to the table to stick into the magic ATM machine. And then you can sit there all day long in front of that thing and pump 20s into it, and it's going to keep spitting you out 25 every time. And so, yes, it's a wonderful strategy. And one of the lessons I've learned, just for a nugget, and then I'll shut up, but one of the lessons I did learn, which is interesting, is that people believe there's a little stigma. People believe that you have to go out and raise private capital from other people to do deals because you're broke. You ain't got no money. All you got is your expertise. And so therefore you must, if you're going to do anything, go get money from other people. That's kind of the stigma behind it. But I want to let you know that, when a multi-billion-dollar real estate developer builds a skyscraper in New York or a giant golf course community in the Bahamas or something like this, okay, they probably have enough money if they wanted to write a check to do it themselves. Can we say that? If somebody's like a billionaire, right? They're already a billionaire. They're going to go build a skyscraper in New York. Well, they probably have the money to do it. Do you know that they even don't use their own money to do it? So I just don't want people to get this stigma that, it's because we're broke and we need to go beg other people for money that have some so we can do it. No. It's the fact that your expertise and your abilities and your connections, and those are the things that add the value to you. And the expertise, political power, connections, systems, team members, all those things that you take forever to build become your value. And those things are more valuable than money. And so that's just a change in mindset for most people. Everybody values money so much. Well, that's because they don't got any. Okay. But if you were to say there's millions of people, even just right there in Arizona where you guys are, right? You go right around Arizona only, and there's a million people in Arizona that have at least the ability to invest $50,000 pretty easily, whether it's cash or out of an individual retirement account, 401k, liquidate stocks, something. They can invest 50 grand next week. So a person that can invest $50,000, a person that can invest $100,000, then should be deemed a dime a dozen. The individual that gains the expertise and the connections and the know-how and the team and the ability to take it and make these transactions very profitable is more valuable. You can't line them up dime a dozen. Matter of fact, you just said it. Most people at these RIA events don't even know that you can own a mortgage. Okay. So we're getting ourselves involved into a niche investment category that still is highly even unknown, which makes it a great opportunity. Right. But yeah, that's just the facts, guys. That's just the facts. You're going to raise private capital or go nowhere. Let's just say that you're going to do small, tiny stuff if you don't know how to raise private capital. If you learn how to raise private capital, you can do things as big as you wish. It depends on the expertise, the connections, the know-how, and the systems that you can gain and put in place that allows you to do bigger stuff. But the sky's the limit if you know how to raise money, right?
I think it all boils down to raising capital at the end of the day. You know, if you can find the right capital at the right dollar amount, right return with the right risk mitigation built in, really sky's the limit at the end of the day. And I think that's a struggle for a lot of people, building that foundation, not only building your education and your due diligence and risk mitigation, but your relationships, your ultimately, stability in a certain market. All of those are really important. And then to actually go out and implement a strategy to raise the money, is a whole nother, bag of worms at the end of the day. To take down a deal, actually consummate a transaction, and start building a repertoire with investors, because they end up referring you to other people that you never knew in the first place. Why? Because, man, you put together a great program. You over delivered instead of over promising. Your risk mitigation was on point. There's risk in real estate at the end of the day, and we all understand that. But it really starts to hit a snowball effect. And I think finding deal flow is more important than ever once that takes place. So once you have that trust of seasoned professionals in your back pocket, you got to know where to go in order to parlay your appetite for transaction ultimately to start performing.
I think you've said it all. I mean, and even Patrick, I think the overall scope of it all is understanding two major components. Obviously, we always run into a cash flow. Cash is an important component, but as Patrick happened to mention, your relationships and those that you have that you can touch to tap into additional cash. But the reality is, most people don't really understand scale. In other words, if you want to grow and do bigger deals, bigger deals, I think there's a big mental factor that comes into play, because a lot of people can't conceptualize getting to that next level. They may be comfortable with doing one deal, then another, two deals, a very slow, over a year, maybe do 1 to 2 deals. And that's their mental transaction thought, because they don't have, say, a coach like Note University or whatever. You need someone that has that mental expandability to be able to scale up, because that a lot of people are scared to do that. I think that runs into a big challenge, because they're scared of that full fear of failure. What if something goes wrong? And they'll question themselves instead of having a mentor, as an example, that's helping them walk through and validate certain deals to make sure that has best chances for success. And then they can create velocity after that. And I think that there's an internal piece that we have to work on, or you have to align with somebody in a mentor status or an education platform to that extent, so that you can feel comfortable to continue to move forward and grow with it. That's my point, in comparison to just doing a one-off deal.
So I have our featured note of the week. I'm just going to break this down real quick for you guys, because this is one of the most, we happen to have two of the most creative transactions we had ever done going down, I think, this month. And this happens to be one of them. So this is a 3-bed, 2-bath manufactured home in the Mesa market, off major cross streets of Ellsworth and Broadway. The address can be found on my previous post, but it's Ellsworth and Broadway, lot 20, Pueblo, Mesa, at 8832 East Pueblo Ave, lot number 20. I acquired this property with $5,000 out of pocket. How did I do that? I structured an acquisition via seller carry finance. So I bought this property from the current seller at the time for $5,000 down, I think it was, if I remember correctly, and at a 4% rate. He wouldn't give me free money. I tried to get a 0% rate. Didn't work out. He was a little savvier. That's okay. We came on an agreement at 4%. right? My objective is to sell this property sooner than later. But that's pretty good, right? To get a 4% rate opposed to like a 8% DSCR loan, you know, in an alternative strategy. 5K down. I acquired it at a $80,000 purchase price. My loan is 75K at 4%. The payments are pretty low, right? So I acquired, I think we put in new carpet and painted the inside. So that's probably 5K out of pocket. I'll have like a $5,000 exit fee of commissions and such. So say I got 10K into it, that's 90,000. Comparables in this park are 130 to 150,000. My objective was to get in and get out pretty quickly. And here it is, right? So you got the updated carpet photos and stuff like that. I did a lasso on apartments.com, you know, to see what average rental rates were in that area, just to make sure I'm pricing everything in correctly. Average rental rates are like 2,200 to 2,500 for 3 and I don't think there was very many 4-bedroom units, especially in a family style environment. Long story short, why does that make sense? Because I structured now a sale with an end user. Now we're fast forwarding to my sale of a new borrower who's buying at 14% interest when the payment actually matches rental rates off those major cross streets. Did the 5-mile lasso. So this note, we were talking about 100,000. It's a $10,000 increase, right? So this is a 3-bed, 2-bath, year 2013 manufactured home, pretty new. Just to preface, 3-2, they paid 120, put 10K down. Your loan balance is 110, so 110,000, 110K, right? And their monthly payment after down payment, 120, put 10K down. And I'm using Carl's mortgage calculator today. For 20 years, 110, 1,367. Actually, you know what? This is a 15% note. 1448.47. So for $110,000 on a 20-year term, you could acquire a cash flowing position with your collateral of a year 2013 manufactured home. It's not just the collateral, people. Remember, it's the buyer's ability to repay the borrower, buyer-borrower, right? So what did we do to facilitate this note out in the market? And why did the borrower what did the borrower do to be approved for this position, this loan? They got a loan from Win Mobile Homes, right? They actually applied twice. They went through the park, who they're actually going through now. The park requires 600 plus credit score, no past criminal, no open bankruptcies, no past evictions, and verifiable income. That means they're an outstanding tenant in layman's terms, right? When you qualify a renter, those are the items they go through, right? So they're a qualified tenant at this point. What do they additionally go through for a loan? When someone goes through a loan, they go through underwriting, additional underwriting outside of the community. That underwriting does what? It qualifies them for their ability to repay, make sure that they're properly disclosed, and ultimately understand the terms of the agreement. So they went through 2 rounds of underwriting and are now paying here in the next 30 days, once we consummate this sale and we get a new lender from you here watching today, at $1,448 a month with no banks. No banks. You stepped into the position, you start cash flowing with $110,000 collateral with the unpaid balance of, say, 90% loan to purchase price. this value of this property is worth 130 to 150. This is actually undervalued of what's comparable in the market. So you could take this note, this featured note, this year 2013 double wide manufactured home in the Mesa market, go to your relationship, your father, your aunt, your uncle, and say, hey, I haven't, boy, do I, whoa, Romeo, whoops. Go to your uncle and say, hey, I have an opportunity here available for you today. And that's $110,000 position, cash flowing at a double-digit yield. If you'd like to understand more of how to calculate what an interest rate would look like on this position, I can tell you how to do it quickly. Go on Carl's mortgage calculator, type in the property value, type in the amount of years that performs, and find this payment. Because I can't quote the interest rate right now, but it is a double-digit yield, right? So you can now garnish private capital at 8% with this position right here. You structure it as interest only. Most of the time is what I try to do within the transaction at, say, 8%, and give them, say, a 1-year term or 1 to 3 years on a hypothecated agreement. And now you've just taken down this asset at below what it's yielding and performing it now possibly for the first time in your investment career. Or you take your current note that you own with us, Mobile Mailbox Money, and cash out that position and buy this note today, right? So I want you to kind of start to run that through your head here, the people that are watching, to understand the availability and how to pitch your relationships and parlay the people that you may know and execute out in the market. You know, residential real estate's really tough to navigate. There's 100% IRA and high net worth investors that are looking for opportunities like this. At the end of the day, it's the truth. You know, there's hardship. People are looking for hedge, and this is it. You know, bar none, there's little to no other opportunity on an income-oriented investment strategy outside of an opportunity just like this here today for someone to actually perform. And I heard it from Patrick said one time, and it hit very close to home. You know, there's always older, higher net worth investors that are looking to place money with new, highly intelligent operators and people that have opportunities that are sound, safe, and stable. And you know, that's really life-changing once you understand that, because it starts to make you look at your relationships that much different at any given time. Like, man, you know, I know this person's high net worth, and Alden said people are hurting for opportunity. I'm going to try it, you know, at the end of the day. So just want you to conceptualize and understand that these opportunities are immediately available. This is just one of a few. Average acquisitions are, you know, 80 to 120,000. We have some that are a little bit lower. You know, Patrick happened to talk to his dentist, of all things. Patrick's got great teeth. He's probably at the dentist all the time. But, you know, talk to his dentist about wanting a return on the market. He's like, hey, man, how do we make this work where I make money and you guys make money too? I'm like, let's figure that out. I'm all over that. You know, there's more than enough opportunity for individuals, seasoned professionals to newer investors, you know, to parlay those conversations, because everyone wants to do a deal at the end of the day. But how do you transfer the understanding, transfer, you know, the security and stability within your conversation of when presenting these opportunities for people to actually start to think, man, you know, that really does sound like a great opportunity. I am only getting 4% in my IRA. Yeah, look, you know what? Let's do it at the end of the day. And I think that starts to open a lot of people's eyes.
I got a good line for you on that one, Alvin.
Here, you've always got great one-liners.
Because it works. That's why, right? It works. I love it. I like to, if you're talking to a dentist, you say, goodness, I respect dentists so much because of their expertise. You know, whenever I have a problem with my teeth, you know where I go, and they're going to go, your dentist, right? And you go, yeah. And you know, my dentist and several other dentists come to me when they want passive cash flow. because that's my expertise. I just shut up. The dentists will start sparking up conversation with real quick when you say that, because you buttered them up. Number one, number two, they all like passive cash flow and good investments. So I like to just say, guys, it's straight up, and it's straight up, isn't it? We talked about skills and expertise. How much work and time and effort does a dentist go through to not only get all the time in to gain the expertise, but then they have to open up a dental practice and become a small business owner and fill it with equipment, hire employees and do books and taxes. It's a heck of a thing, man. It took a lot to get that expertise to be able to be a resource to me when I have a problem with my teeth. And oftentimes they're so busy creating active income, which they're obviously very good at, that they don't have the time to seek out expertise on passive income strategies. It's just like I don't have the time to go and study how to do my own filling, nor would I want to. And they don't want to become a house flipper, and they don't want to become a professional note investor, right? As I rely on my dentist also relies upon me, and we become a good matchup. And so I like saying that to other dentists, right? So obviously start with your own. If you're looking to raise private capital, when next time you go get your teeth cleaned, you better mention, hey, doc, I love coming to you every 6 months to get my teeth cleaned. I love your expertise, and you're so good at what you do. And, I'm pretty good at getting dentists passive cash flow. And
So how many dentists do you have? You're like, Patrick's like, I'm at a dentist every single month. I got like 10 dentists.
I'm trying to book a teeth cleaning with a new dentist every 6 months, right? No, but there is clubs that dentists belong to, and there are dental conferences, and there's also good ways. Facebook, you can look up, and people have dentist on their title of who they are on LinkedIn, this kind of stuff. So it's not like, but the point is, it's a great line to say to those dentists, and it's a good opening liner, because you're buttering them up. Because boy, I'll tell you, anybody on this call, do you fix your own fillings? Exactly. So when you can become the resource to the people that are good at what they do, because you're good at what you do, and it's a high level income earning expert position, like a dentist, an orthodontist, a chiropractor, these are all high income earning people that don't have the time, guys. They're running their practice from 8 o'clock in the morning to 5 o'clock at night every day, and taking their kid to soccer practice on Saturdays. So you can be a really good resource for them.
So high net worth, busy professionals, whether it be trades owners, lawyers, dentists, general practitioners, or people that have inherited wealth, all the above are great areas of potential transaction at the end of the day. So we're here at 12:50. We've got Sonny and Sean on here, and they're some of our liaisons. And they're still, we're all building our repertoire to ultimately provide further communication, better clarity into the program, and into stepping into being a private lender. Today, again, is brought to you by Silvercrest Opportunity Fund, 506C. Let's say you didn't want to go out and, add note investor into your bio and take the time and effort to learn the due diligence, learn how to structure an acquisition, and why to bake that into your due diligence. You could invest accredited in Silvercrest Opportunity Fund, which is performing notes. You become a per unit owner's share, actually, in the portfolio of notes that we take down, just like this note of the day here today. So 12:51, that's the Mobile Mailbox Money Podcast. Crazy amount of value today. Go back and watch this if you hadn't, had the chance to absorb. Sometimes it feels like you're drinking from a fire hose, because there's not a lot of publicly available information like this, as well as with deal flow right in front of you. You could literally go back and watch this, take exactly what we said to go do, right? And start performing in the next 30 days. And I encourage you to do so. Reach out to Sonny, Sean, or even Patrick with the Note Investor University for, any inquiry into how we navigate niche market real estate notes. We're going to cut it a little bit short here today, but that was crazy amount of value that we did. We got our note of the day, and currently raising in Silvercrest Opportunity Fund, trying to get financial freedom at the end of the day. So I appreciate each and every one of you being here today. We'll see you in 2 weeks, Thursdays, 2 weeks from today, 12 o'clock Arizona time. Appreciate it, everyone. Bang.
Really, 10% for the year, it's clear that this the new wave. Little competition in my arena. Need a house, man, you call Serena. Strategy so born, didn't even mean to not remind them. There's another check right behind them, right behind them, right behind them. 10% passive. The check.